Hi, and welcome to another episode of the Michael Yardney podcast. Now, today we're going to be diving into a subject that might not be the most glamorous, but is unequivocally crucial for anyone interested in property investment, and particularly if you're keen to be running a business. And we're going to talk about ownership structures, and trust me, how you set things up can have a lasting impact, not only on your asset protection, but on your tax liabilities and on your flexibility to grow in the future. And I'm joined by Ken Race, founder of Metropole Wealth Advisory, who's renowned as Australia's leading expert in property tax and structuring. And I'm going to be picking his brain on the ideal structures for two main scenarios. First of all, for anyone who's interested in getting involved in property development, whether you're just beginning or a seasoned developer, we're going to delve into the best structures for undertaking small property development projects. And even if you're not interested in getting involved in development just yet, I think it's probably going to be the sort of thing that you need to think about for the future. Look, let's face it, the wrong structure could expose you to unnecessary risks and tax obligations. And then the second half of this podcast, we're going to be shifting gears slightly, but sticking with the same theme. We're going to be discussing the best structures for setting up your business. So whether you're a startup or running a more traditional business or a professional practice, understanding the nitty-gritty of ownership structures can save you a lot of headaches down the line. Today's discussion, I'm going to aim with Ken to give you a 360-degree view, focusing on three pillars: protection, tax, and flexibility. So if you've ever wondered about the pros and cons of different ownership structure setups, whether trusts, companies, old-fashioned personal ownership, you don't want to miss today's episode, so let's get started.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Ken.
Hi, Michael. How are you?
Good, thank you. Now, Ken, in previous podcasts, we explained about the importance of owning your own investment properties in the right structures. And I know that you gave us ideas about flexibility, about asset protection, about tax benefits. And in particular, in a number of our sessions, we talked about the ability to pass on assets to future generations in an effective way. Now, clearly, there's not one correct structure. So what we're going to talk about today is not specific advice. Look, if there was one simple answer, there wouldn't be so many options. So we can't give specific advice. But at the end of this, I want to actually help our listeners and viewers of this to have an opportunity of finding out how they can find out more by speaking with your team. But let's start off with structures available for those interested in taking a more active role in property and getting property development, because you and I have seen too many investors begin their journey on the wrong foot. They've not got the best structures for their portfolio. So what are the options somebody could consider if they want to get involved in a small property development?
Yes, thank you, Michael.
That was a long introduction, wasn't it, Ken?
It was good, but my ears were pinned to that speaker. Property has a different layer of complexity compared to other businesses. And in fact, we should be running our property developments as a business. But property has a couple of unique areas that need to be specifically looked at, and that is normal tax and land tax and stamp duty. So the complexities of the structure can be a little bit daunting to a lot of accountants, to a lot of lawyers, and certainly the layman. And what we traditionally find is people go for the KISS principle, keep it simple. The trouble is they end up having to pay more tax than they should have, probably more land tax. They can't have flexibility in distributions. They lose the potential for the 50% capital gains tax if they ever sell. So lots of hurt points, if you like, with the wrong structure. And traditionally, people either buy in their own name. And look, can I say at the offset, if that's what you're going to do, forget about the development. If your development can't support the cost of a structure, you shouldn't be doing the developer, even if it's just your mindset isn't there. So if we get rid of sole trader, individual names, then we've got things like companies, unit trusts, family trusts, partnerships, joint ventures, self-managed super fund. So these words just keep coming at us, like which one do I pick? So as you said, Michael, there's not one optimal solution, but you've got to pick the one that meets your basic needs. So
I found, Ken, is a lot of people spend a lot of time trying to work it out and what suits them now. But what suits now isn't necessarily what's going to suit them down the track in the future, is it?
correct, for two reasons. Things change, and also your intentions might change with what to do with that property. So you need a level of flexibility. So traditionally, people use a company, but the problem with a company is they own the shares. So it doesn't give them the flexibility if they decide to keep it, because then they lose the 50% capital gains tax discount. In some states, there are land tax benefits, but there's bigger downsides. And a company is really controlled by the shareholders. A company is split by shares, and different people may own those shares, and then the profits, capital gains would be distributed. Another more flexible structure, which gives you basically the same rigidity at the top, is what they call a unit trust, because a unit trust is split up into segments, unit holders. The same as you own shares in a company, you would own units in a unit trust. And that normally gives you a lot more asset protection, a bit more flexibility, and you get that 50% capital gains tax discount if you sell. If you're looking at developing using the traditional family trust, that can work for a lot of people. But there again, if you decide to keep that and that property is negatively geared, then you can't claim the negative gearing against your PAYG tax instalments. So you need to be in business in the correct structure to be able to get those tax benefits. People use partnerships a lot. They have their pluses and minuses, but you've got to consider that if you're in a partnership, each partner has joint and several responsibilities. So you could be landed with the problems of your partner, which we don't want.
And Ken, that clearly includes finance as well. In other words, if you go into joint and several loan with your business partner or family member, which sometimes is the case, if they can't keep up the loan, you're responsible. But more than that, the bank sees that right from the beginning. So it actually limits future borrowing capacity on other potential purchases, because you only get 50% of the benefit of owning the property, yet you are still theoretically liable for 100% of the loan.
Correct. So that really impacts that borrowing capacity. So joint ventures can be a very good structure, particularly if you've got mixed intentions. I'm going to build, of which I'm going to keep some and sell some. I'm going to be working with somebody else. But at the end of the project, we want to retain our own properties in our own structure, not in joint venture with someone else. And if you couple that with, I'll use the term a co-development agreement, then that allows you to split those titles without the triggering of tax, GST, and stamp duty in most states.
So what actually happens, Ken, is most people don't realise, if you and I, for example, go together into a development, we own all the land initially, then we own part of Unit 1 together, half each, and half of Unit 2 together. But you want to own Unit 1 on your own, and I want to keep Unit 2, but I've got to sell you half of mine, you've got to sell me half of yours, which could, unless we document it correctly, trigger stamp duty, GST, and in fact, a profit as well, because the tax department will see the end result, hopefully, is going to be worth more than the parts of the cost together. So that negates a lot of the benefit of joint ventures unless you set it up correctly right from the beginning. And I know that's something you've been doing with our clients at Metropole Wealth Advisory for quite a number of years. Now, something that most accountants, most solicitors, most tax advisors aren't even aware of, because it's actually not something that the average person even gets involved in.
Correct, because that document, while it's got some commercial aspects to it, it's actually more tax driven. So you really need tax expertise in the preparation of those documents.
Well, I know that my kids have been involved in property development, my children, because it was easier for them to do it together, and then they've separated and they've got individual units, and you've helped them on 2 separate joint ventures being able to do that, and it's definitely worked really well. Well, that's a personal story, but also for a lot of our clients. But I think it's worth, I know it's important to actually see you and your team before you even start getting involved. You've got to set it up right from the beginning, preferably before you buy the property.
Before you sign the contract, that's pretty critical. Another one from left field, if I can call it that, is using your self-managed super fund. And maybe before I talk about it too much, this is going to be general advice. It's not specific. So don't just go out and do it because Ken said something. So you've got to get specific advice looking at your specific circumstances. So this is just general information in fact, nature.
For most people with a self-managed super fund, it's not even appropriate. But I think it's important because a small group of people it works for.
Correct. And there are 3 ways, if you like, to do developing using super funds. So you can either do it by yourself with cash, or you can use a specially designed unit trust if you're working with somebody else, where you can actually even borrow and use that property as security. Very strict rules and criteria to be able to do that, but it is possible if you meet those tests.
So in summary, there's a whole lot of structures that you could get involved in if you're going to get involved in development. Of course, these are similar structures that you should consider before you buy your investment properties as well. Companies, trusts, joint ventures, partnerships in your name and your spouse, etc. So it's critical to consider what the finance, the tax implications, the long-term implications are. So my suggestion is that you get professional advice before considering getting involved in purchasing your property, and particularly before getting involved in property development. Now, Ken, in a moment, I want to spend some time talking about structures appropriate for people who are thinking of setting up a business or owning a business or professional practice. But maybe I should just explain at this point that our team at Metropole Wealth Advisory actually provide tailored strategic advice for people. And many of them are high net worth individuals, but also just ordinary mum and dad investors. And I'm not saying that lightly when I call them mum and dad investors. That's a typical expression that's used because you specialise in helping them set up the appropriate entities, Ken.
That's right. And because this is an area that requires some expertise and knowledge in accounting, in tax, in commercial documentation, in tax strategies, stamp duty, land tax. So it's, can I call it a one-stop shop where you can actually get that advice and actually have the inputs for all those particular areas of professional input to get the most appropriate answer for yourself.
Now, similarly, if you're interested in considering setting up a business, whether it's an online business, a professional practice, the old fashioned brick and mortar store or whatever, I think it's really important to have the right structures as well, Ken.
Absolutely, particularly in business, because too many things can happen in a business that are outside of your control. And even things you do control, things happen from left field.
So why is having the right business structure critical? I mean, it's a self-serving question, Ken.
Dorothy Dix, I think they call it in Parliament.
Yes.
Yeah. So, look, we don't go into business with the expectation to fail. I mean, if that's what you're doing, maybe go and donate your money. So success can come in many shapes and many sizes, and it's important to start off correctly, knowing what you're trying to achieve, because the right business structure can actually help you while you're growing the business, while you're maintaining the business, and more importantly, when you sell that business. And I cry, that's probably the correct word. I cry at the amount of clients we do business restructuring for, where 5 years ago, 10 years ago, 15 years ago, they didn't seek the right advice. And now they're looking at selling their business and they're effectively paying double the tax that they would have had they got the proper, correct advice at the beginning. So they're big numbers. When I say double, it is double. And in some instances, it's a lot more than that. So when starting a business, it's all about the services and the products and who your clients will be. And we're all excited about that. And normally very little time is spent on the business structure. We leave that decision to somebody else. It's akin to building your dream home without looking into the future of how you're going to use that home. I'm going to get kids in the future. I want to do an extension. And if you set it up correctly at the beginning, those things are much easier to do later on. So if you take all these things into account, then you build that business and the structure with maximum efficiency and flexibility in mind. Build it with the end in mind. And that's what you should be doing with the structure. And look, just as a little side note, I'm laughing, I should be crying. I was surprised at a recent accounting continuing professional development day I went to just very recently. And they emphasize use a company as your business structure because it's low cost, it's easy to use, and you're probably going to be the only one to get your money out of it. And that's the accounting profession teaching accountants. And I thought, no wonder. And look, when I went back to my university days, we spent a little bit of time on companies, virtually no time on trusts. So it's an area that's not, can I say, sufficiently understood.
So what sort of things should you be looking for when you're deciding which structure you need to consider for setting up your business, Ken?
Yeah. Look, asset protection, I mean, we all try and do the right thing, but the proverbial happens. We want flexibility. We want to be able to think of what happens if I want to bring a new partner in or get rid of a partner. We need to understand cash management. And most business owners generate income so that they can invest as well as live. So you need a business structure that efficiently allows you to use those business profits in your future endeavors to invest in property, in expansion. You need to look at your exit strategy. What happens when it's time for me to shut the door? Do I want to sell? Do I want to divest? Do I want to leave it to my children? All those questions. And yes, taxation. Because different structures will give you a completely different tax outcome. So very critical. There's a lot of balls in the air. So you need to work with somebody who can dilute them down to the 2 or 3 specific priorities you would have, guide you on that, and then pick the right structure.
Okay, Ken, so what are the various business structures one could consider?
Yeah. We did talk about a sole trader. That's an individual just working under their own name. They trade as an individual. All the income, all the expenses go to that person. There's no asset protection, and they're taxed at their marginal tax rates. So it is quick and simple, but it leaves you exposed to all those attacks from anyone, clients, the tax man, anybody. So not appropriate. I mean, if you're going to knit beanies and sell them at the local store, maybe it's appropriate, but you still got to consider about public liability and things like that. So I would say for most people, it's not a good way to even start. So the next generally accepted structure is a company. A company is a legal entity which is separate from its owners. That's why if something goes wrong in that company, then they sue the company. They don't necessarily sue you as the director. Now, obviously, you still can be sued as a director if you do things that are fraudulent, if you acted while the company was insolvent, and there's outstanding tax liabilities, you as a director are responsible. So that company is broken down into shares, and each owner owns their particular percentage. And a company pays a flat rate of tax, and people think, oh, this is fantastic. I'm in a company, I only pay 25 cents tax. Well, what happens when you want to take the money out? You take out the profits as a dividend, you have to pay the top-up tax. So it eventually gets back to your marginal tax rate. And if you want to use that money for investing in, say, a property, then you're using after-tax money to invest, and then you have the challenge of getting refunds back from the ATO, and we all know how challenging that can be at different points in time. So that company can retain the money, cash in a company, doesn't have to distribute it all, but the problem then is if that company sued, all that cash is available. And you've just got to be a little bit careful with, there's something called personal services income, where the ATO wants the person who did the work to get the money. So don't think that just because I've got a company, I can distribute all the money to my wife and partners and children and things like that. So companies provide a form of asset protection, but it's limited liability, which is only the assets from inside the company if the company is sued. Your personal assets owned in your name are not protected if you are individually sued. So everybody knows companies, you order it, ASIC spits it out. It's a traditional, the rules of a company, the government dictates what those rules are. A third way is a trust. And there's different types of trusts. So maybe before I get into those different types of trusts, a trust is an entity that holds the assets, generates the income. It is not a legal entity, the same as a company or a person. So as such, it needs something to sign on its behalf, and that's called a trustee. And normally that would be a company. So a trust does not pay tax. You still got to do a tax return and say who the money went to. And then the ATO data matches to make sure that the individual who was said to receive the money did get the money, and the tax is paid at the rate by the person who receives the money. So it's like a pass-through vehicle. So I personally like the idea of only paying tax at the very end, as opposed to paying it along the way and trying to claw it back. You've just got to be very careful then that it's operated correctly, that your resolutions are correct. But that is a pretty flexible tool for asset protection, estate planning. It gives you a good exit strategy because you do get a 50% capital gains tax discount on the sale of that business, which if you sell a company, you don't, because people normally, if they buy your business, if it's in a company, want to buy the assets in the company. They don't want to buy your shares and all the liabilities.
So there's obviously different ways one's taxed, different levels of asset protection, different levels of flexibility, ability to let people in the business or pass on your business. Clearly, it's not simple. And so therefore, again, it's a smart investment to speak to somebody about this before they start. And I know when you speak with clients, you explain all this, but what are some of the misconceptions, the thoughts people have that are wrong when they come to see you about this, when they first discuss these issues with you?
So if we're looking at a company, maybe to start off with, people normally use a company because they want asset protection and to minimize their tax. Well, can I say at the onset, nothing could be further from the truth. They normally, as an individual, own the shares in that company. So that means they get all the money. And imagine you've created a very successful business that allows you to go to the beach 2 or 3 times a week. You've got good managers, everything's hunky-dory. But if you get sued, those assets are very valuable. So you could lose those shares. The receiver in bankruptcy would get it, and you would lose your income stream. So not a good vehicle when you're looking at asset protection, flexibility, and certainly tax management. So if people are going to use a company, I say at least have a more flexible owner of those shares, such as a trust. So the only way you can get money out of a company is by wages, which is after tax, or a dividend, which is after tax. And if you sell and the company sells the assets to the buyer, you lose that 50% discount. So you don't get a lot of the benefits you think you're going to get when you use a company. If I focus on trusts, we've got to get the right trust. That we're going to use a family trust if it's just our own individual family. Do we need a unit trust if I'm going to be working with other business partners? So unlike a company where the government authorises the actual terms and conditions and dictates the minimum requirements of a company, a trust rules are created by the lawyer who produces that document. So clearly going to somebody who understands the nuances of a business can help you get the right trust from the right lawyer.
So just to make it clear, a trust's really a document, something that's written, words and clauses. There's nothing new about this. They've been around for hundreds of years.
Thousands of years.
Initially to protect the knights, I'm told, when they went to war, and if they died, the royalty, the kings would take their land. So I think it was the monks started up these trusts to protect the wives of the knights. So nothing new about this, but you've got to do it right, because I've seen so many people who thought they were protected by a trust or had their flexibility or interests covered by a trust. All it needed was a few extra clauses or some updates, and then they got what they wanted, Ken.
Correct. When you buy a trust, a lot of people think that's the 100% of the task, but that's really only 20%. The other 80% is doing those last couple of things, setting up the correct resolutions to get them going, doing the annual distribution minutes correctly. All those little things are dotting the I's and crossing the T's, which the ATO loves to pounce on, to say you've done it wrong and you shouldn't be entitled to tax benefits. So one of the biggest, areas I see of mistakes is the longevity or the life cycle of a trust. A typical trust lasts 80 years. That doesn't have to be the case, because what happens at year 80? Those assets have to be moved out of the trust to beneficiaries, and in a lot of cases that would trigger capital gains tax and stamp duty. So we've gone to a lot of work and trouble to actually create trusts that actually have no end date.
Now, people think, hey, 80 years, hey, that I'm not going to be around then. Interestingly, my first trust was set up in 1976. So it's been around for a long, long time. And I now have not just children, but grandchildren, and want to pass things from the Yardney Family Trust on to them. So that's really now become more important to me, when 50 years ago I would have thought, not a big deal.
That's right. And we get a lot of second and third generation people come to see us who say, my great-grandfather set this up, or my grandfather set it up, and my accountant is telling me next year it won't be there anymore. What can I do? So that is a big benefit that a lot of people would like to have. Again, if they go to the right person who understands this, then you can actually get a trust that has longevity. And that's truly then intergenerational wealth transfer. You've got to be very careful of, at the end of each year, your minutes, your resolutions to distribute the money. It's got to be done correctly, because if it's not, the ATO, as I said, jumps on these things and tries to deny you the ability to use that.
Now, interestingly, in a recent podcast, I interviewed Tim Lowe, Assistant Commissioner of Taxation. He's told me how many, was it millions of dollars, or that the tax department was now investing in their data matching service. They get information from all sorts of places. Legally, it's the way they do things. And I went through an audit last year and came out squeaky clean. But you've got to do it correctly, because you never know when they're going to knock on your door and say, hey, can I have a look at your records?
Correct. And the ATO is spending hundreds of millions of dollars on IT. So data matching is just getting more and more refined. So it's hard to hide.
One of the things they looked at with me, Ken, was loan agreements, which were all documented and correct. But people sort of think I'll take some money out of the trust and I'll give it back later, or I'll put some in and I'll take it back later. That's all allowed as long as you do it correctly.
Correct. And that's where people fail, in that they're a bit sloppy in their administration and compliance. Now, it doesn't take hours and hours to do. I mean, the individual wouldn't be doing it. You would be entrusting your legal advisor, accountant, or tax practitioner. They understand these things if they understand trusts. It's second nature to that type of person.
Now, again, Ken, we're not giving specific advice, but we're just allowing people to get an understanding of what sort of business structures could be used. But I know that you turbocharge some of our clients' entities by operating multiple structures. Maybe you could just explain a little bit about this.
Yep. So when you're generating a lot of cash flow, when you're generating the need for cash for plant and equipment, fit outs, if you're going to have a number of shops, you actually need multiple structures to get, can I say, that finely tuned business actually delivering the cash flow you need. So we use things like bucket companies. I mean, the ATO hates that term. We call them corporate beneficiaries. We distribute particularly from a trust into this bucket company, but that has to be set up correctly. And one of the big mistakes we see is people again become the individual shareholders. And just as a little bit of an example, a number of years ago at a ATO tax liaison group meeting, they were talking about bucket companies. Are they tax avoidance? And the ATO says, well, people come back to us and they say they want it for asset protection, estate planning, flexibility, intergenerational wealth transfer. And the ATO said, it is unlikely you can support that argument with an individual shareholder. So with an individual shareholder of that bucket company, you're likely to lose an argument with the ATO. We use other entities alongside your business unit to maybe hold the assets. So we can buy the assets and then we lease them back, or we push stock under consignment. That then protects a lot of the value of that business. We actually have got intellectual trusts for people who are particularly running franchises or want to expand their businesses into multi-locations. We keep all the smarts in one entity and licenses to the operating entity. And that creates another level of asset protection. All those different things to improve it when necessary, and when the costs, can I say, where the benefits far outweigh the costs.
I think people are going to think, gee, there's all these entities. I've already been running my professional practice. We see that with a lot of medical practitioners, health practitioners. Oh, I've been running my business for a long time. It's too late. So I would be suggesting that you should get the correct advice initially. But if not, Ken, are you still able to help people by reviewing their current business structures?
There is certainly potential for significant improvement on a review. There are things you can do to improve the position that you could be in if you're in the wrong structure. So we would definitely recommend people review their structures because there's normally something you can do, either quite drastic, move the whole business to another entity, and with the various tax concessions, there could be very little capital gains tax.
So, Ken, I bet you some people are listening to this and thinking, this is all very interesting, but I already have an accountant. He's advised me. Why should I bother seeing Ken and the team at Metropole Wealth Advisory?
That's a very good point, Michael. And what we do is we work with your accountant. And in a medical analogy, we're the specialists and they're the GP. We've never had real problems with working with accountants because they understand the limitations of what they do. How many business restructures do they see in a year? One? None? Whereas we're seeing this all the time. And we're working with the legal profession to actually keep refining what's available, what you can do. We keep up with all the laws because a lot of it is law as opposed to accounting. So you need to have that input.
I think that's one of the great differences of Metropole Wealth Advisory and other organisations that help people with their wealth, and that's the multidisciplinary position that you take, understanding the language of law, business, property, tax, and you're sitting in the middle because they're all speaking different languages, aren't they?
Correct. And you need a translator, or you actually need someone to speak on your behalf to make sure that all those pieces of the jigsaw puzzle fit together to your maximum benefit.
So my recommendation is, if you're considering setting up a business, getting involved in property development, already have a business, or again, just thinking of getting involved in property investment, why not catch up with Ken Race and his team at Metropole Wealth Advisory? I'll leave a link in the show notes, and have an initial no obligation chat with one of our wealth strategists, just to see if we can help you. And if we can, we'll genuinely tell you. And if we can't, similarly, we'll tell you, because we don't want to waste your time or ours. Thank you so much for your time.
Thank you, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you a provocative quote by the late actor and humanitarian Hugh O'Brien. And when I read it, I actually had to look at it twice, because he said, people are not created equal. He said, I don't believe all people are born equal. He said, created equal in the eyes of God, yes, but physical and emotional differences, parental guidelines, varying environment, being in the right place at the right time, all these play a role in enhancing or limiting an individual's development. And he's right. He went on to say, but I do believe every man and woman, if given the opportunity and encouragement to recognise their potential, regardless of their background, has got the freedom to choose in our world. Will an individual be a taker or a giver in life? Will that person be satisfied merely to exist, or seek a meaningful purpose? Will he or she dare to dream the impossible dream? And he finished off by saying, I believe every person is created as the steward of his or her own destiny, with great power for a specific purpose, to share with others through service a reverence for life in the spirit of love. Well, interesting thoughts. So, no, we're not all born equal, but if you're listening to this in Australia, or one of the other great countries that a lot of people listen to this podcast in, you've already won the lottery in life. You've won the lottery by being born at this time. Now, I know there are a lot of challenges going on in the world, and probably in your life personally, but you have the opportunity, as Hugh O'Brien said, to decide your destiny. You're the steward of your future. So be the pilot of your life. Don't be a passenger just going on a ride. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?